Okay, let's unpack this. Think about this for a second. Back in, say, 1500, the entire globe produced maybe $250 billion worth of stuff, goods and services.
Right, that's the estimate. Seems almost quaint now, doesn't it?
Totally. Because fast forward to today, and that number is, well, it's a staggering $60 trillion.
A huge leap. And it's not just the total.
No, exactly. Per person, the average has just exploded from around $550 a year back then to, what, $8,800 now.
It's incredible, that kind of jump in per capita wealth.
I mean, the source calls it an economy like a hormone-soused teenager, just relentless, almost uncontrolled growth.
That's a vivid image. And you're right, at the heart of it all, this massive expansion, there's this one really powerful word, growth.
So for this deep dive, we're basically on a mission, right? To understand the underlying creed, the fundamental beliefs that have fueled this economic supernova.
It's fascinating because for most of human history, the economy wasn't like this at all. It was relatively stable.
Stable, yeah. Increases were mostly tied to, like, population growth or finding new land, nothing like this.
Exactly. The real shift we're talking about is this sustained exponential increase in per capita production that really kicks off in the modern era.
So how did we get there? From that static state to this constant upward climb. The source uses a great little story to explain a key concept: credit.
Ah, yes, the bank, the contractor, and the baker. Samuel Greedy, A.A. Stone, and Jane McDonough.
Right, so Greedy starts a bank. Stone, the contractor, deposits $1 million cash. Simple enough.
Mm-hmm.
Then along comes McDonough, the baker. She's got a great idea for a bakery, but no actual dough.
Literally. Needs capital.
So she gets $1 million loan from Greedy's bank. She then hires Stone, the contractor, to build the bakery.
Who then deposits that million right back into Greedy's bank.
Exactly. So now Stone's account shows $2 million, but the bank, it still only has that original million in actual cash in the vault. Where did the extra million come from?
Well, this is a perfect, simple illustration of fractional reserve banking, isn't it?
Right. Explain that a bit.
The bank isn't just sitting on the money. It knows, statistically, not everyone will demand their cash at once. So it lends out a big chunk of it, maybe 90% money, that isn't physically there.
So it's based on what?
Hope. It's based on trust, collective trust in the future. Trust that the loans will be repaid, that the system will hold.
Okay, and the story gets even crazier. McDonough hits a snag, needs another million.
Right. Unexpected costs happens all the time in business.
Greedy gives her another loan. That money goes to Stone again, who deposits that million. So now Stone's account says $3 million.
But the bank's vault, still just that $1 million in cash.
It sounds completely nuts, like financial magic almost.
It does seem counterintuitive, but the key difference the source highlights is crucial. It's the shift from money only representing existing, tangible stuff.
Like gold coins or bushels of wheat actually in the barn.
Exactly. Versus the modern idea of credit, where money can represent imaginary goods, things that don't exist yet, but hopefully will exist in the future.
So, in McDonough's case, the imaginary goods are the future profits from her successful bakery.
Precisely. Greedy the banker is betting on her future success. He trusts that her bakery will generate enough profit for her to repay the loan, plus interest. Then, if needed, Stone could actually withdraw his $3 million.
And that is the massive insight, isn't it? Credit breaks that old pre-modern trap.
What trap was that?
The trap where you needed wealth already to create more wealth. McDonough couldn't build her bakery because she didn't have the money up front.
Right. Lack of capital prevents new ventures.
But credit lets her build it now, based purely on the expectation of future income. It's all about belief in what's coming.
Exactly. If money only represented tangible things already here, financing anything new would be incredibly hard. You'd need workers willing to build the bakery now and only get paid years later if it succeeded.
Which almost never happened, so economies stayed pretty small, relatively stagnant.
Really limited potential.
Okay, so if credit is this amazing engine, why wasn't it used more effectively throughout history? Why the big boom only recently?
Well, the source makes it clear it wasn't that people didn't understand lending or borrowing. Forms of credit have been around for ages.
Right, moneylenders are hardly a modern invention.
No. The real bottleneck was a fundamental lack of trust that the future would be significantly better than the present or the past.
So it was a mindset thing again.
Very much so. There was this widespread belief that the total amount of wealth in the world was limited, like a pie. A fixed pie, or maybe even a shrinking one.
If the pie is fixed, then any gain for me must be a loss for you.
Exactly. Economics becomes a zero-sum game. If someone gets rich, it's probably because they took more than their fair share or exploited someone else.
Which explains why getting rich was often seen as, well, a bit dodgy, morally speaking.
Right. Think about religious traditions. The source mentions Jesus and the difficulty of a rich man entering heaven. If wealth is limited, hoarding it or accumulating vast amounts seems inherently selfish or sinful.
So the expectation was, if you did get rich, you should give a lot of it away through charity, sort of to balance things out.
That was often the social expectation, yes. A very different outlook compared to today, where wealth creation is often celebrated.
So you had this cycle. Limited trust in future growth meant limited credit. Limited credit meant it was hard to finance new businesses,
Which meant the economy didn't grow much.
which just reinforced the belief that growth wasn't really possible, a self-fulfilling prophecy of stagnation.
Precisely. Then something changed dramatically. The scientific revolution.
Okay, how does science connect to economics here?
The scientific revolution wasn't just about discovering new facts about the universe. It fostered a whole new way of thinking. The idea of progress.
Progress, meaning things can actually get better. We can learn more, invent things, improve our lives.
Exactly. The admission of ignorance, we don't know everything, coupled with observation and research, led to the belief that humanity could overcome problems and improve its condition over time. And this idea spilled over into economics.
So people started thinking, maybe the economic pie isn't fixed.
Right. If we can make new discoveries, invent new technologies, find better ways to organize trade and production, maybe we can actually increase the total amount of wealth. The pie can grow.
So my new chocolate cake bakery doesn't necessarily put your bread bakery out of business.
Maybe not. Maybe people just decide they want both bread and cake. Total consumption increases. It's not necessarily zero-sum anymore.
I like the growing pie analogy. It completely changes the perspective.
It really does. And once you believe the pie can grow, you start trusting the future more.
Which makes you more willing to extend credit.
Exactly.
Yeah.
And that credit fuels new ventures, which leads to economic growth.
Which then validates the belief in progress and strengthens trust in the future.
You've got it. It's this incredibly powerful, self-reinforcing cycle. Belief in progress fosters trust. Trust enables credit. Credit drives growth, and growth reinforces the belief.
And this cycle, operating over the last 500 years or so, is what led to the explosion of credit we see today. Governments, companies, individuals, all borrowing massive amounts based on this expectation of future prosperity.
It underpins the entire modern financial system.
Okay, this seems like a good moment to bring in Adam Smith. 1776, The Wealth of Nations. The source calls it maybe the most important economics book ever. What was his big idea?
Smith's core argument, especially in that famous Chapter 8, was pretty revolutionary for its time. He basically said that the individual's urge to increase their own private profit, what we might call greed or self-interest, is actually the basis for collective wealth.
So being selfish is good.
In a way, yes. Smith argued that when an entrepreneur tries to make more money for himself by creating a better product, finding a cheaper process, whatever, he inadvertently benefits society. He hires workers, pays suppliers, creates something people want. It's the invisible hand guiding self-interest towards the common good.
That must have really challenged traditional morality, the idea that pursuing personal gain wasn't inherently bad, but maybe even virtuous.
Absolutely. It flipped the script. Instead of seeing the rich person as potentially taking from others in a zero-sum game, Smith presented a win-win scenario. My profit doesn't have to be your loss. In fact, my pursuit of profit might create opportunities for you, a job, a product you value.
So the rich person isn't the villain anymore, as long as...
As long as they reinvest their profits back into increasing production. That's the key.
Yeah.
Don't just hoard your gold or spend it all on luxuries. Use it to build more factories, hire more people, invent new things.
So that's the capital's ethic, reinvestment. Profits must fuel more production.
Exactly. And this is where the source draws that important distinction between wealth and capital.
Right. Wealth is just assets. Money sitting there, maybe a fancy pyramid.
Or jewels, or a lavish estate used only for consumption. Wealth that isn't actively working to produce more.
Whereas capital is.
Capital is money, goods, resources that are invested in production. The factory, the machines, the money used to pay workers before the product is sold. Even the factory worker buying stocks is turning wealth into capital.
That's a really useful distinction. And this idea of constant reinvestment for more output was pretty alien to earlier societies, wasn't it?
Largely, yes. Think of medieval nobles. Their ethic often involves spending wealth, conspicuously lavish feasts, tournaments, building grand cathedrals, demonstrating status through consumption and generosity, not necessarily maximizing future production.
Whereas the modern capitalist elite, the CEOs, the financiers, even if they live comfortably, their primary focus within the system is supposed to be reinvestment, growing the business.
That's the ideal, yes. The focus shifts from consuming wealth to using capital to generate more capital.
And this isn't just for billionaires. The source points out how ordinary people grapple with this too. Do I put my savings in the stock market, capital, or buy a bigger TV, consumption?
Or how governments decide whether to spend tax money on, say, immediate social programs versus investing in infrastructure or education that might boost future economic growth. These are fundamentally capitalist decisions about reinvestment.
So capitalism starts as an economic theory, but it becomes this broader ethic, almost a worldview.
Definitely. Economic growth becomes the supreme good, or at least the necessary foundation for achieving other goods like justice, freedom, maybe even happiness.
And you see that today, right? The answer often proposed for problems in developing countries is more economic growth, more free enterprise.
That's often the default capitalist prescription, yes.
Yes.
Foster affluence and other problems will supposedly sort themselves out.
And this creed, this belief system, has had a massive impact on science. How does that work?
Well, think about who funds scientific research today. Governments, corporations. They tend to prioritize research that has potential economic applications.
Research that might lead to new products, new industries, increased production, more profits.
Exactly. It's not that pure research doesn't happen, but the flow of money is heavily influenced by this capitalist imperative for growth. Can this research make the pie bigger?
But it's a two-way street, isn't it? Capitalism needs science, too.
Absolutely critical. That belief in perpetual growth. It relies heavily on scientific breakthroughs and new technologies creating new avenues for expansion.
Like the discovery of the Americas, the invention of the steam engine, the internal combustion engine, computers, genetic engineering.
All these things opened up vast new possibilities for production and profit, fueling the growth engine. The source makes the point that governments and banks can print money, essentially creating credit based on future hope.
But ultimately, it's the scientists and engineers in the labs who have to deliver the breakthroughs that make that future wealth real. Otherwise, the whole thing collapses.
It's a high-stakes dependency. Right now, there's immense pressure on fields like biotech and nanotech to be the next big thing, the engine that justifies all the credit created, especially since the 2008 financial crisis.
So we're kind of betting the farm on future innovation.
In many ways, the current economic system is structured exactly like that.
Okay, shifting gears slightly, but connected. The source strongly links the rise of capitalism with European imperialism. How are they intertwined?
The argument is quite forceful. Capitalism wasn't just helped by imperialism, it was a crucial driver of it. And in turn, imperialism shaped how the capitalist credit system evolved.
But credit existed elsewhere, right? Asia was economically dominant for a long time.
Yes, absolutely.
Yeah.
Credit systems existed in Asia, and Asian economies were larger and more advanced than Europe's until maybe the late 18th century. Europe was relatively poor back then.
So what was different about European imperialism?
The role of credit and finance seems to have been much more central. In many non-European empires, like the Ottoman or Chinese, expansion was often led by military elites and funded primarily through taxes and plunder. Bankers and merchants might have played a role, but they weren't usually in the driver's seat.
Whereas in Europe,
Kings and generals increasingly started thinking like merchants. Conquests became intertwined with investment and profit. The source has that striking line: empires built by bankers defeated the empires built by kings.
why? How did bankers beat kings?
Because the mercantile capitalist approach was much better at financing expansion. Raising taxes is often unpopular and politically difficult, but selling shares in an expedition or raising loans based on expected future profits from colonies, people might line up for that. It unlocked vastly more resources.
The Columbus example is used here, right? Struggling to get funding because it was so risky.
Exactly, a huge gamble. But when it paid off for Spain, it demonstrated the potential rewards and encouraged more investment in exploration and conquest.
And this created that magic circle of imperial capitalism.
Right. Credit finances discoveries and conquests.
Which lead to colonies.
Colonies generate profits through resources, trade, taxes.
Those profits build trust in the investors and the state backing them.
Which makes it easier to get more credit for further expansion. It's a loop that traditional tax-funded empires couldn't easily replicate.
And to make these risky overseas ventures more appealing, they developed joint stock companies.
Yes, a crucial innovation. instead of one wealthy nobleman funding a whole voyage and risking ruin if the ship sank.
You could get hundreds or thousands of people to invest smaller amounts. They buy shares in the company undertaking the venture.
It spreads the risk dramatically. If the venture fails, each investor only loses a limited amount. But if it succeeds, everyone shares in the potentially huge profits. This model mobilized far more capital.
And that basic structure is still the foundation of stock markets today.
Absolutely. This sophisticated financial system, geared towards funding potentially profitable ventures anywhere in the world, gave European powers a massive advantage.
The Dutch Republic is held up as the poster child for this, isn't it?
A prime example. A tiny country, not many natural resources, fighting for independence from the mighty Spanish Empire. How did they do it? Largely, yes. While the Spanish king struggled to fund his armies, often defaulting on loans and eroding trust.
The Dutch built a reputation for reliably repaying their debts.
Exactly. And critically, they established a strong, independent judicial system that protected private property rights, including those of foreign investors.
That story about the German financier telling his sons where to invest really drives that home. One son invests in Spanish ventures, the other in Dutch ones.
And the son, who invested in Amsterdam, thrived, protected by the law, while the one investing in Madrid faced the risk of the king seizing assets or changing the rules arbitrarily.
So trust wasn't just about repaying loans, it was about the rule of law protecting investments.
Absolutely fundamental. Capital flows towards places where it feels secure. The Dutch gained that trust while Spain lost it.
And the Dutch used these joint stock companies, like the VOC, to project power globally.
The Verenigd Oostindische Company, the Dutch East India Company, an incredible entity. Funded by private investors, it raised its own armies and navies.
Waged wars, signed treaties, built forts.
And effectively conquered and ruled Indonesia for almost 200 years, primarily in pursuit of trading profits.
That's staggering power for a private company.
It really highlights the potential scale and, frankly, the dangers when corporate power and state power become so intertwined, driven by profit.
They also had the West India Company, the WIC.
Yes, less successful overall, but it founded settlements like New Amsterdam.
Which became New York. And Wall Street got its name from the wall the WIC built there. Amazing how finance is literally baked into the landscape.
History leaves its mark.
But the Dutch didn't stay on top forever. Britain and France eventually overtook them. France seemed stronger initially. What went wrong there?
The source points to France's financial system hitting a major roadblock with the Mississippi bubble.
Ah, the bubble. Sounds ominous.
It was a classic speculative mania. There was this company, the Mississippi Company, with grand plans to colonize and exploit the Mississippi Valley in North America. It was heavily promoted by a financier named John Law, who managed to become head of the company, governor of France's central bank, and the finance minister all at once.
Wow. Talk about conflicts of interest.
Indeed. He essentially tied the company's fortunes to the national finances. There was huge hype about the potential riches in Louisiana.
So people piled in, buying shares.
Piled in is an understatement. Share prices went through the roof, based on pure speculation, not actual profits. People borrowed heavily, sold assets, desperate to get in on the action.
Sounds familiar.
Very. And inevitably, reality started to bite. It became clear the promised riches weren't materializing quickly, if at all. Some savvy investors started quietly selling.
And then, panic.
Panic. As prices dipped, more people tried to sell, driving prices down faster. Law tried to use the central bank to prop up the price by buying shares, but that just entangled the bank further and burned through its reserves.
What was the end result?
Complete collapse. The bubble burst spectacularly. Share prices became worthless. Thousands of investors, especially smaller ones, were ruined. The French financial system was severely damaged, and trust in the state's financial management was shattered.
And this had consequences beyond just the investors.
Big time. It made it much harder and more expensive for the French crown to borrow money afterwards. Public distrust was high.
While Britain,
despite its own bubbles like the South Sea bubble, managed its finances more prudently overall and maintained better credit. It could borrow large sums relatively easily and at lower interest rates.
which gave them a huge advantage in funding their navy and expanding their empire.
Exactly. France's financial weakness, exacerbated by the Mississippi bubble fallout, hampered its ability to compete globally and contributed to losing its overseas empire to Britain.
And the source even links France's massive debt problems, partly stemming from this era, to Louis VI having to convene the Estates General in 1789.
which of course kicked off the French Revolution. So a financial bubble had massive political and historical repercussions.
Meanwhile, the British Empire just kept growing, often powered by these private joint stock companies operating out of London.
Yes, like the British East India Company. It started as a trading venture, but ended up conquering vast swaths of India, fielding a private army larger than the official British army.
Napoleon called the British a nation of shopkeepers, right? Kind of dismissively.
He did, but those shopkeepers, backed by London's financial might, ultimately defeated him and built the largest empire in history. It shows the incredible power of capitalism fused with imperial ambition.
Now, later on in the 19th century, the British and Dutch governments took direct control of many colonies from these companies. Did that break the link between capitalism and empire?
Not at all, argues the source. If anything, it may have strengthened it, just changed the mechanics slightly.
That's so.
Now, powerful companies didn't need to run colonies themselves. They could lobby their home governments in London, Paris, Amsterdam to act in their interests, use national armies and navies to open markets, protect investments, enforce contracts.
The government becomes, as Marx apparently put it, a kind of trade union for the capitalists.
That's the idea presented. National interest and the interests of powerful capital holders become increasingly blurred.
The First Opium War is used as a stark example here.
A truly grim example. British merchants were making huge profits, selling opium grown in India to China against the wishes of the Chinese government, which was worried about addiction.
So, when China tried to crack down on the drug trade,
Britain went to war. In the name of free trade, they forced China to accept opium imports and seized Hong Kong as a base of operations. It was basically a war fought to protect the profits of British drug companies.
that's pretty damning.
It illustrates the potential dark side when state power is used to enforce private economic interests, regardless of the human cost. The story of Egypt is similar in some ways.
How did that play out?
Egypt borrowed heavily from European investors for modernization projects, like the Suez Canal. When Egypt struggled to repay the debts, European powers intervened, first financially, then militarily, when a nationalist revolt threatened their investments. Britain ended up occupying Egypt and making it a protectorate, ensuring the loans were repaid.
So, the flag followed the debt.
Often, yes. Even war itself could become intertwined with finance. The Greek rebellion bond example.
Right. People bought bonds backing the Greek revolt against the Ottomans.
And when it looked like Greece might lose, which would mean the bonds become worthless, the bondholders' interests suddenly aligned with British national interests in weakening the Ottoman Empire. Britain intervened militarily, helping Greece win independence and ensuring the bonds got repaid.
It's a complex web of finance, politics, and power.
And it had a lasting effect. It reinforced the idea that a country's credit rating the market's trust in its willingness and ability to repay debts, often backed by the implicit guarantee of a powerful empire, could be more important than its actual natural resources.
So, a stable country, trusted by investors, could borrow cheaply and develop, while a resource-rich but unstable country might stay poor because no one would lend to it.
That became a major factor in global economic development, and still is to a large extent. Access to capital is key.
Okay, this leads us to the idea of the cult of the free market. What's the core belief there?
It's the argument, pushed by ardent capitalists, that markets work best when left alone. Minimal government intervention, low taxes, deregulation.
The idea being that private investors, guided by the profit motive and competition, will automatically allocate resources most efficiently and generate the most growth for everyone.
That's the theory. Keep politics out of economics. Let the invisible hand do its work, and resist government spending on things like welfare or even big military adventures, as those distort the market.
But the source argues this is a bit naive, doesn't it? This belief in a completely free market.
Yes, because the most crucial economic resource isn't capital or labor, it's trust. And markets themselves can't guarantee trust.
You need rules. You need laws against theft, fraud, violence. You need contracts enforced.
Exactly, and that requires a political system, courts, police. Without that underlying security and enforcement provided by the state, markets can't function effectively. Fraud and mistrust would run rampant.
Like the Mississippi bubble or maybe the 2007 U.S. housing crisis examples where lack of sufficient regulation or enforcement allowed things to spiral out of control.
Precisely. They serve as reminders that markets need effective frameworks and oversight to prevent collapse and maintain trust. Pure laissez-faire can be dangerous.
And then there's the really dark side. Adam Smith's idea that individual greed benefits all. The source pushes back hard on that, right?
It asks the critical question: what happens when the easiest way to increase profits isn't through innovation, but through exploitation?
Like paying workers less, making them work longer hours in worse conditions.
Exactly. The free market theory says workers are protected because they can just leave and go work for a competitor who treats them better.
But what if there are no competitors? Or what if all employers collude to keep wages low?
Then the market doesn't protect the workers. And it gets even darker when mechanisms like debt peonage or outright slavery are used to eliminate workers' freedom altogether, maximizing profit at the cost of human dignity.
And the source connects this directly to the Atlantic slave trade, arguing it wasn't just some relic of the past, but that its massive expansion was fueled by capitalism.
Yes, it's a provocative and disturbing argument that the rise of European capitalism, with its relentless drive for profit and its sophisticated financial tools, was a key factor in the explosion of the transatlantic slave trade.
How so?
The immense demand for cheap sugar, cotton, and tobacco grown on plantations in the Americas. Producing these commodities cheaply required vast amounts of labor.
And enslaved Africans became the cheapest, most controllable source of that labor.
Tragically, yes. The argument is that unrestrained market forces the demand for cheap sugar in Europe. The potential profits for planters and traders created a powerful economic incentive for the enslavement and forced transportation of roughly 10 million Africans under horrific conditions.
And this wasn't necessarily driven by state policy, but by private companies.
Largely, yes. Private slave trading companies, financed by investors buying shares on European stock exchanges, Amsterdam, London, Paris. People invested because it was profitable.
So the pursuit of profit, facilitated by the mechanisms of capitalism, directly fueled this atrocity.
That's the argument presented, that it shows a fundamental flaw. Free markets, left purely to their own devices, have no inherent moral compass. They don't guarantee fair distribution or prevent horrific exploitation if that exploitation is profitable.
It wasn't necessarily about racial hatred, although that existed, but about indifference.
Cold indifference coupled with greed, as the source puts it. The investors buying shares, the plantation owners calculating costs, the ship captains. Many were perhaps detached from the brutal human reality, focused only on the bottom line.
And the source emphasizes this wasn't unique. The Bengal famine under the British East India Company, where profit was prioritized over feeding the local population.
Or the VOC's actions in Indonesia, ruthlessly exploiting resources and people for commercial gain.
And even later, King Leopold II's horrific regime in the Congo Free State, extracting rubber through forced labor that killed millions, all for personal profit.
These examples are presented as evidence that the drive for profit within a capitalist framework, if unchecked by ethical considerations or effective regulation, can lead to catastrophic human consequences.
So where does that leave capitalism today? The source acknowledges things have changed somewhat since, say, the mid-20th century.
Yes, it suggests that capitalist greed has been somewhat restrained, partly perhaps due to the ideological challenge posed by communism during the Cold War and the rise of social welfare states in some places.
But inequalities obviously still persist. The global pie is vastly bigger, but many people still struggle immensely.
Exactly. Which leads to that provocative question. Has the whole project of modern economic growth been, in a way, a colossal fraud? Similar to how the agricultural revolution brought benefits, but also new hardships for many.
What are capitalism's main defenses against that charge, according to the text?
Two main lines of argument are presented. First, like it or not, capitalism has created the complex world we now live in, and it's the only system seemingly capable of running it. The alternatives tried, notably communism, have arguably proven far worse.
Okay, the least bad system argument. What's the second?
The second is the promise of future growth. Yes, the distribution is unequal now, but just give it more time. Keep the pie growing. And eventually, everyone will be better off than they were in the past, even if perfect equality is never achieved. There's enough to go around eventually.
And the text does concede that on many objective measures, life expectancy, child mortality, calories consumed, the average person today is better off than in, say, 1914, despite huge population growth.
That's the statistical reality capitalism points to as its ultimate justification. The pie has grown, and average slices are bigger, even if some slices remain unfairly small.
But that brings us right back to the final, massive, hanging question, doesn't it?
The elephant in the room.
Can this economic pie, which must keep growing according to the capitalist creed, actually continue to grow indefinitely,
Yeah.
especially on a planet with finite resources and fragile ecosystems?
What happens when we hit those limits? When the resources run out or the environmental consequences become unbearable, can the engine of perpetual growth keep running?
And what happens to the whole system, built on trust in that future growth, if the answer is no?
That is perhaps the central question facing humanity and the capitalist system in the 21st century, a question with no easy answers.
So to wrap up then, we've traced this incredible story, haven't we? From the revolutionary power of credit, born from a newfound belief in progress.
To Adam Smith's radical idea that self-interest could fuel collective prosperity through the crucial mechanism of reinvesting capital.
We saw how this capitalist engine intertwined, often brutally, with European imperialism, reshaping the globe through joint stock companies and financed conquests.
And we've grappled with the double-edged nature of it all, the immense wealth generation, but also the potential for devastating exploitation and inequality when profit becomes the sole motive, and the dangers of unregulated markets.
We've seen how the system relies on trust, how it shapes science and politics, and how it now faces this profound challenge of sustainability.
It really provides a deep historical context for understanding the economic world we inhabit today, its strengths, its weaknesses, and the profound questions about its future.
Definitely leaves us, and hopefully you listening, with a lot to chew on about where we go from here. Thanks for joining us for this deep dive.